to the second segment in our Business of Medicine e-learning series. My name is Sean Murphy, and I have the pleasure of serving as the CEO for the Harris County Medical Society. In this video, we will be discussing things to consider when financing your practice. With me today is Jordan Golson, Senior Vice President of Private Banking with Amegy Bank, who's going to tell us about what physicians need to know when it comes to personal banking. We also have Kristen Smith, Senior Vice President of Commercial Banking with Frost Bank. Jordan, turning it over to you.
So we've spent quite a bit of time talking about what you may need to set up a practice or join a practice, but also just as important is thinking about what you may need on the personal side for you and your family as well. So really setting up the basic checking, savings, or money markets accounts for you and your family. Not only having that everyday account, but also having set aside a savings account, something called a rainy day fund. Setting aside about 3 to 6 months worth of savings. Should you need them for emergency purposes, you would have them kind of readily available for you should something happen. Personal financing, we're going to take a deeper dive into this, but making sure that you've got a banker you can call should you have a large project coming up, a large investment that you may need funds for. Being able to talk to somebody and explaining to them what you may need the funds for and having them walk through which products may be appropriate for you is important. So in hand with personal financing is also the need for a mortgage or construction loan. Having somebody that you can talk to regarding the application process, how to get pre-approved, really the products that they offer, and making sure you understand what those rates will look like is just as important when you're going through and thinking about buying a home or building a home. And then lastly, wealth management and financial planning, not only making sure that you're preserving and growing your wealth, but also protecting it appropriately for you and your family as it continues to accumulate. So with all that being said, I think the major takeaway here is making sure that you've got a bank and a banker you can trust and really dive into your full financial picture, your goals for you and your family, and making sure the banker understands that as well and can assist you along the way. So now we're going to take a little bit of a deeper dive into personal financing. Some standard products that you'll find available for you are mortgages and construction loans. If you're looking to purchase investment property, a home equity line of credit, an investment line of credit, or an unsecured line of credit or loan. One key component here that I want to touch on is an investment line of credit. If you have investments or a brokerage account, you probably have the ability to get a line of credit on that account. And the key thing here is that interest rate is typically going to be a pretty low interest rate because you've got such liquid collateral backing the line. And then some reasons you may need to borrow money. Again, purchasing or building a home. If you're going to do a large remodel on your home, that might be something to consider. We talked about partner buy-in loans. Those are pretty common in the healthcare industry if you're looking to buy into a practice or a surgery center. And then you just kind of have the standard car, boat, RV loans, debt consolidation. Or you may find that your income fluctuates throughout the year. So maybe you just need access to funds on a line of credit should cash flow needs arise and the income is going up and down throughout the year. So those are really just things to consider. Now we're going to talk about mortgage and construction loan financing. One of the first things you need to consider when you're thinking about getting a loan is the amount of funds required for that purchase or that home build. Typically, banks will look for at least 20% down. Some banks do offer physician mortgages that will allow you to put a lower down payment. However, it may come with a higher interest rate or the requirement for mortgage insurance. So those are things that you really just need to consider when you're talking to your bank and making sure you're getting the details of all the products that they're walking you through. Again, understanding what you can afford. We talk about budgeting. Going through your monthly income and comparing it to your monthly expenses and really figuring out how much cash you have left over each month. Another way to look at it is what we call debt to income. So taking your monthly loan payments and putting that over your monthly income and figuring out what that percentage is. If you can keep that percentage maybe less than 40%, you're really kind of in good shape. Also with that is making sure you understand the difference between adjustable rate and fixed rate mortgages. Adjustable rates are going to have a fixed rate for a certain period of time, and then that rate will adjust. Whereas your fixed rate product, such as your 15-year or your 30-year product, is going to have a fixed rate for the life of the loan. And then lastly, the loan process. Getting a mortgage or a construction loan can be a pretty strenuous process. There is typically a lot of documentation required. So just making sure you understand it's really not an overnight process. It can take about 30 to 45 business days to really get something set up and get to closing. So just making sure that you're keeping that in mind when you're going under contract.
Well, Jordan, that's great information. Help me understand the adjustable rate versus fixed rate. We know a fixed rate, you're locking in the interest rate for a designated period of time. An adjustable rate, how does that work and why would someone maybe want to consider that?
Yeah, so the adjustable rate really comes into play when you don't plan to stay in your home for longer than 10 years. So let's focus on a 10-1 ARM product. Your rate is going to be fixed for the first 10 years of that note. It is still a 30-year note, comes with a 30-year amortization, just like a 30-year fixed mortgage. However, the key difference is your interest rate is only going to be locked for the first 10 years. Following those 10 years, your interest rate has an ability to adjust up or down depending upon where the market is at that time. So taking into consideration how long you plan to stay in the home, there is a difference in rate when you look at ARM products versus fixed rate products. Your ARM products are typically going to come with a lower interest rate, so that's something to consider. And then if you plan to pay off your mortgage rather quickly, if you're a high earner and you've got funds and you just are debt adverse, an ARM product is something to take into consideration versus a fixed rate product.
Great. Well, thanks for all the information about personal banking. A couple just overarching questions I'd like to ask you both when it comes to personal banking. So first, we're seeing the recent rate hikes that are taking place in the United States. How does that impact a monthly loan payment?
Yeah, absolutely. So if you have a fixed rate, no impact. Obviously, your rate is locked, hopefully for the life of your loan, so it really should not impact you from that standpoint. If you have a floating rate, more than likely you've seen that rate increase throughout 2022. There is the potential that it could continue to increase. But again, keeping track of where that rate is and keeping track of how that impacts your monthly payment is important. If you have the ability to pay off that floating rate debt, that might be something you need to consider.
Sure. One thing we talked about was a rainy day fund, and you should have 3 to 6 months of a rainy day fund. So let's say you have that already taken care of, and then you have an extra couple $1,000. For purposes of this hypothetical, let's say you have $5,000. What are some options you could consider on where to house that for the next couple months or year?
I think it depends on how liquid you want to keep the funds. So if you don't necessarily need the funds right away and you have the ability to kind of lock them up, a CD may be best suited for you. Or there are investment options. With $5,000, you may be able to go in and buy some stock and really kind of play with your money from that standpoint. It's just going to depend on how liquid you really want to keep those funds.
Sure. Anything to add on that, Kristen?
So a CD or a certificate of deposit, it can be on the bank side or it can be on the investment side. So talk to your advisor, see what may be best for you. There's different rates involved with what you can get as far as returns. Same with putting it in the market. There's rate of returns there. So there's some risk, but you can have some great rewards. So it's all about looking at your risk adversity and your risk tolerance. And then, like Jordan said, when are you going to need these funds again? Are you okay with having them put in something for 12 months, or do you need them in a month or two? Then maybe just putting it in a money market or a savings account might be best.
So again, having the relationship with your banker can really help guide you as far as where to put money like that.
Absolutely.
All right, last question. So we talked about putting together a personal budget. When it comes to your personal budget, how often should you analyze that, maybe make tweaks to it? What do you recommend there?
Yeah, so a really great time is if you're having any changes to your personal expenses or your personal income, you got a salary increase. Congratulations, take a look at your budget. You bought a new car, take a look at what those monthly payments are going to be now. And anytime that you're applying for any type of loan product, whether it's on the personal side or the business side, they're going to want to see that personal financial statement and that statement of cash flows. So it's great to have those ready. Doing them annually is a great exercise to just reassess where you're at with your budget, with your expenses, your income, and maybe even find some extra money to put in one of those savings products we talked about.
Great. Anything to add to that, Jordan?
No, I would just echo, I think at least annually is important. Again, life changes, important to kind of reconsider where you are. I would completely echo what Kristen said.
Great. Well, listen, I want to thank you both for your time. Kristen, Jordan, it's been a pleasure. Thanks for all the valuable information. And with that said, thanks for you watching. Harris County Medical Society is here to support you. So we appreciate bringing you this series, and there will be more to come. Thank you.